Hi everyone, welcome to Digital Expert.
In this video, we are going to discuss 7 electronics manufacturing stocks which is targeting more than 30% revenue growth in FY25. So the Indian EMS sector is seeing some significant growth due to some favorable government policies and the China Plus One strategy. The electronics manufacturing services in India is at the beginning of an incredible growth journey. The global companies are also looking to diversify their supply chains, and India is emerging as a preferred hub for electronics manufacturing. I would say that the growth in the electronics manufacturing sector has just started and there is so much more potential. So for investors like us, this means there is a massive growth potential from the electronics manufacturing stocks. If you like this video, don't forget to subscribe to this channel and share my videos with your friends and family or anyone who might be interested. Also, check out this playlist for sector-wise stocks. You can see separate videos for stocks like data center, semiconductor, telecom, transformers, pharma, agriculture, and many more. So let's get started. The first stock is an important name in the electronics manufacturing industry. So this stock is a key beneficiary of several production-linked incentive schemes for mobile phones, IT hardware, white goods, lighting, and AC components. So this stock manufactures a wide range of electronic products from consumer electronics and lighting to home applications, mobile phones, and security devices. The market cap of the stock is 92,177 crores. The stock I am talking about is Dixon Technologies. The current price of the stock is 15,715 rupees. We've already spoken about the stock many times in this channel. So Dixon is showing solid revenue growth projection for the FY25 because of its strong focus on the expansion and innovation across multiple segments. So under the PLI scheme, Dixon aims to achieve an annual revenue of 45 to 50 billion rupees by FY25 in the mobile phone segment. Under the telecom and networking segment, Dixon is expected to touch a 24 billion revenue by FY25 with a big target of scaling up to 60 to 70 billion rupees in the next year. Over the past 5 years, revenue and the net profit has been grown at an impressive CAGR of 42.8% and 42.7% respectively. So this growth has helped Dixon to maintain a strong ROCE and ROE, averaging at a 21.2% and 30.3% over the last 5 years. So Dixon's expertise in assembly and product development positions it well to tap into the rising global demand for electronics. So for Dixon Technologies, the PLI scheme has been a game changer, particularly in the mobile phone manufacturing sector. So back in FY20, only 12% of the Dixon's revenue came from mobile phone production. But because of the PLI scheme, this number has jumped from 40% in FY23 to an impressive 62% in FY24. In FY24, the Dixon's revenue surged 45% to 177 billion, while net profits grew at 47% to 3.8 billion. The company achieved this while maintaining stable operating and net margins. Price to earnings ratio is 128.89, higher than sector P ratio of 86.78. Debt to equity ratio is lower than 1. Return on equity for the last financial year was 24%. The next stock is a leading solutions provider for the air conditioning industry in India. This company has a significant market share in the room air conditioner market and serves as a key original equipment manufacturer and the original design manufacturer for various prominent brands. So this stock offers a wide range of products within the RAC industry, including complete air conditioners, components like heat exchangers, fans, PCBAs, and other non-AC components. The market cap of the stock is 21,887 crores. The stock I am talking about is Amber Enterprises. The current price of the stock is 6,483 rupees. In the RAC segment, they manufacture complete air conditioners, including window ACs and split units with various specifications. So this stock produces PCBs for consumer durables, home appliances, and telecom sectors. They've also expanded into smart wearables and telecom equipment. In the mobility application segment, they offer HVAC solutions for coaches, railways, and defense, as well as energy-efficient BLDC motors. Amber has set an ambitious growth plan aiming to double its revenue in the electronics division over the next 3 years. So this target is backed by a strong order book of over 2,000 crores and an ever-expanding product portfolio. On the financial front, from FY20 to 24, the company achieved a CAGR growth of 19.6% in sales, while its net profits saw a growth of 8%. AMPA has also been consistently maintaining strong financial metrics with an average ROE of 8.4% and an ROCE of 12.8%. The company expects a robust performance in FY25 with an AC industry likely to grow over 30% in volume year on year. Price to earnings ratio is 117.80, higher than a sector P ratio of 86.78. Debt to equity ratio is lower than 1. Return on equity for the last financial year was 8%. The next stock is a leading Indian electronics manufacturing service provider with a strong emphasis on high-tech and high-reliability electronic systems. So this company caters to a critical sectors such as aerospace, defense, space, medical and industrial electronics, offering end-to-end design, manufacturing and life cycle management solutions. The market cap of the stock is 2090 crores. The stock I am talking about is Sendem Electronics. The current price of the stock is 1620 rupees. So Sendem Electronics is part of a collaboration to launch India's first constellation of Earth observation satellites. The satellites will be multi-sensor, all-weather and have a high revisit rate. So Sendem has delivered mission-critical electronics for various satellite programs, including the prestigious Chandrayaan and Mangalyaan projects. Sendem Electronics offers a comprehensive spectrum of design services and manufacturing capabilities for mission-critical products. So these solutions are offered through key operating business units that work together to address the customer needs. So with a global footprint, Sendem Electronics operates in India, Europe and North America. The most interesting part is that Sendem Electronics is a single source supplier for around 80% of the products they manufacture. On the financial front, from FY20 to FY24, the company has achieved a CAGR growth of 3.2% in sales. They also have consistently maintained strong financial metrics with an average ROE of 3.4% and ROCE of 12%. So going forward, Sendem Electronics plans to expand its EMS business through investment in international sales and marketing. So this stock has a negative P ratio. The debt to equity ratio is higher than 1. The next stock is a prominent player in the Indian manufacturing industry, specializing in air conditioners, expanded polystyrene packaging, and pre-engineering buildings. So this company has achieved the milestone of being the largest processor of EPS packaging in India. So this company is the second largest original design manufacturer of RAC in India with a market share of 25% in domestically manufactured units. The market cap of the stock is 3,774 crores. The stock I am talking about is EPAC Durable. The current price of the stock is 399 rupees. So EPAC Durable specialize in manufacturing room air conditioners including window and split ACs and hold a 24% market share in the domestically manufactured ODM units. The product portfolio includes a variety of complete air conditioners ranging from window ACs to split ACs with different capacities and energy ratings. The company supplies to major clients like Blue Star, Daikin and Voltas, which maintains a long-term relationship. The company forecasts 40 to 50% revenue growth for FY25, with the air conditioning segment projected to grow at a comparable rate. On the financial front, from FY22 to 24, the company achieved a CAGR growth of 24.5% in sales, while its net profits saw a growth of 65.6%. It also has consistently maintained strong financial metrics with an average of ROE of 9.5% and ROCE of 19.2%. The price to earnings ratio is 79.29, lower than sector P ratio of 86.78. Debt to equity ratio is lower than 1. Return on equity for the last financial year was 5%. The next stock is a leading end-to-end and IoT solutions integrated electronics manufacturer in India. So this company's expertise spans across automobile, industrial, aerospace, defense, IoT and IT industries, giving this company a broad reach into sectors which is likely to grow under Trump administration that promotes America First policies. This comes with his preference for partnership outside China. So this company can readily scale production in high demand areas like smart meters, consumer electronics and even aerospace, meeting the demands of a potentially expanded client base. The market cap of the stock is 37,489 crores. The stock I'm talking about is Kainos Technology. The current price of the stock is 5,909 rupees. I've already spoken about this stock many times in my channel. Kainos has built a robust foundation in electronic system design and manufacturing services. So Kainos has a substantial order book for more than 30 billion set for execution over the next 18 to 20 months. So this provides good revenue visibility for its growth trajectory. For FY25, the company expects strong performance across all verticals, aiming to exceed the revenue estimate of 30 billion and achieve an EBITDA margin of 15%. So this growth will be fueled by organic revenues, existing products, and a broader customer base in sectors like industrial, automotive, and railways. The exports are also projected to increase from 15% to around 20% by FY26. Price to earnings ratio is 157.90, higher than sector P ratio of 86.78. Debt to equity ratio is lower than 1. Return on equity for the last financial year was 9%. The next stock specializes in design, manufacture, and assembly of plastic molded components and parts for various electronic products. The market cap of the stock is 17,892 crores. The stock I'm talking about is PG Electroplast. The current price of the stock is 677 rupees. This is also one stock that I have spoken many times in this channel, but I can't avoid this stock when I talk about the electronics sector. PG Electroplast offers a full range of services from design to final assembly. And PG Electroplast serves as a one-stop solution for electronic product manufacturers. The management foresees some large opportunities in the plastic molding and consumer durables like washing machine, room ACs, refrigerators, along with opportunities in the ODM space. The company has revised its revenue and profit projections for FY25, reflecting its growth momentum and strategic initiatives. The company now targets a revenue of 48.5 billion rupees, representing a remarkable 77% year-on-year growth compared to FY25. Similarly, the net profit guidance has been upgraded to 250 crores, showcasing an impressive 83% year-on-year growth over FY25. And in FY25, the company's sales and net profits grew 27.2% and 76.9% respectively. Its cash flow from operations more than quadrupled to 1.86 billion rupees. The price to earnings ratio is 93.29, higher than sector P ratio of 86.78. Debt to equity ratio is lower than 1. Return on equity for the last financial year was 16%. The next stock is a leading player in the EMS sector. This stock is into electronics manufacturing services, offering integrated solutions to original equipment manufacturers. They are also experts in precision manufacturing, catering to a variety of industries. It's a company that plays a key role in bringing cutting-edge products to life. So this stock specializes in everything from product design and engineering to printed circuit board assembly, box building and testing. The market cap of the stock is 9,370 crores. The stock I am talking about is Syrma STS. The current price of the stock is 555 rupees. Syrma STS Technology serves a diverse range of industries including automotive, consumer electronics, healthcare, industrial, IT and railways. The consumer sector brings about 32% of the revenue and the automotive brings 20% of the revenue. As the businesses are trying to diversify their production away from China, Syrma STS Technologies is well positioned to capture this demand and its strong capabilities in the electronics manufacturing. So Syrma STS is a leader in RFID product manufacturing in India, which gives them a strong position to leverage the increasing demand for automation and digitalization across industries, including supply chain, retail and logistics. So FY20 to FY24, the company achieved a CAGR growth of 54.9% in sales, while its net profits saw growth of 42.8%. For FY25, the company aims for a revenue target of 45 billion rupees with a growth guidance of 40 to 45%. Price to earnings ratio is 88.38, higher than its sector P ratio of 74.17. Debt to equity ratio is lower than 1. Return on equity for the last financial year was 6%. If you like this video, don't forget to subscribe to this channel and thank you for watching.